In this recording, we're going to continue on with IAS 16. Particularly, we're going to pick up where we left off in the live webinar. We focused on the different scenarios we're dealing with the revaluation model. So we looked at a first-time revaluation upwards, where the revaluation gain goes to the OCI, and we looked at a first-time revaluation downwards, where the revaluation loss goes to the SOPL. And we said it gets more complicated then when you deal with a second and subsequent revaluation. Now, that's relatively straightforward when you have a revaluation up followed by another revaluation up and up, or you have one where it's down and down, because they follow the same trend as before. Where it gets more complicated is in these scenarios, example 5 and example 6, where you have vice versa. A revaluation up followed by a revaluation down, or a revaluation down followed by a revaluation up. And IAS 16 has particular rules in terms of how we focus on this. So if we look at, for example, the 31st of December 2019, there's a property that was revalued to 162,000. And at that date, there's a revaluation surplus related to this asset of 25,000. So it was previously revalued upwards. Right? The fair value of the property was assessed as 200,000 based on the previous revaluation. The balance on the accumulated depreciation account as at the revaluation date, 31st of December 2019, is 30,000. What we want to know is prepare the journal entry to recognize the revaluation at that date. Right. So what essentially we're saying here, it's important that we watch exactly what information is given. We're told here, number one, the fair value of the property was assessed at 200,000 based on a previous revaluation. The balance of the accumulated account depreciation is 30. So we'll say the cost is 200 based on the previous revaluation. Now you can call it cost in inverted commas if you wish, because it's coming from a previous revaluation. The accumulated depreciation, in this case, is 30. So that is the net book value at the 31st of the 12th of 19 is 170. And we're saying here it's revalued, the revalued amount is 162. Right, there, that's all the key information given in the question. It can be quite complicated the way it's laid out, so it's important to try and read between the lines and figure out what exactly is the information that I'm looking at. So we're saying here the net book value at the end of 2019 is 170, it's revalued 162. So that is a reval loss of 8,000. A revaluation loss of 8,000. Now, usually if that was a first-time revaluation loss, we would put all of that to the P&L. But this is a second-time revaluation. So if we go up here, up to the previous slides, example 5 is a revaluation up and then down. So this is a second-time revaluation that is going down. So what the rule is here is you first offset any loss against any previous revaluation surplus. So in our case here, that 8,000 doesn't have to go to the P&L. It can be written off against the 25,000. So you will debit accumulated depreciation, which is 30. So as you said, this is now 30 minus 30 equals 0. That's where you want it to be. This is now nil. We put that red. You will adjust the cost account. The new cost account has to be brought down. You are going to credit the cost, which is essentially the updated fair value. You're going to bring that down from 200 down to 162, which is a fall of 38. And then you're going to debit the reval surplus through the OCI 8. So notice there now, the cost, this is now 200 minus 38 is 162. And the reval surplus is brought down. So the updated reval surplus is 25,000 minus 8,000, which is 17,000. So you see, when you have an existing revaluation surplus, the key thing being it must be in relation to that asset. You cannot use a revaluation surplus related to other assets. So you must match the surplus with the particular assets you're revaluing. So the rule is there, any reval loss first goes against the reval surplus. There is another little quirk to watch for. For example, if this loss was 38,000, then the first 25 would go to the reval surplus, debit the reval surplus 25. The rest, the 13,000, would go to the P&L. So you can only wipe out the reval surplus up to its amount. Any loss above the existing reval surplus, that goes to the P&L directly. So that's something to watch out for in questions. That is an example where you have a previous revaluation upwards, which means you have a revaluation surplus, and then a subsequent reval downwards. And the rule is there, the loss is wiped out against the existing surplus first. And any loss above that, then that portion goes to the P&L. So hopefully that makes sense. Example 6, then we'll look at the opposite scenario where you've previously an asset that was revalued down and is now revalued upwards. So let's have a look at the details. Revalued previously to 120,000, and since that revaluation, depreciation has been charged to the asset of 24. So you're saying the updated cost was 120 based on previous revaluation, and accumulated depreciation was 24. So that means the net book value then is 96 currently. That asset was previously revalued as its first revaluation. It is an expense of 12,000 in the P&L. So the first time revaluation, which ended at 120,000, gave you a revaluation loss. Debit the SOPL 12. Now you're told its fair value again. The revalued amount, in this case, is 110. So that's going to be a reval gain. And the reval gain here is to the tune of 14,000. Previous revaluation brought to 120, that gives a 12,000 loss. This one is giving you a 14,000 gain. So be careful here, there's clear rules. If you have a loss previously, you can reverse that loss first. So we'll do the first normal things. Debit accumulated depreciation, 24. And this is now 24 minus 24, 0. You will, in this case, credit the cost account, 10. This is now 120 minus 110. So 20 minus 10 is 110. You're bringing it down to the revalued amount. So the net entry here is, and this we have to be careful, we're going to credit the SOPL 12,000. You're allowed to do that to reverse the previous loss that would have been there. You're saying that loss is no longer valid, so you can reverse it this year. But you can only credit the P&L the amount of the previous loss. You can't credit the 14, because otherwise that would be inflating and bringing a credit straight to the P&L, which would not be fair. Right? What you do instead then is any surplus reversal would be like a normal one. You'll credit the reval surplus in the OCI. And that will be 2,000, which is the excess revaluation over and above the previous loss. So just be conscious and watch for that in questions. Where you're looking at is similar logic here. When you're reversing a loss, you're reversing a gain, you can reverse it up to a limit. Anything else, then it goes to either the P&L if it's a loss or the OCI if it's a gain. So it's a bit more complicated when you get to those subsequent scenarios, up and down or down and up. And there'll be other examples of those in the question pack for IAS 16 that you should practice as well. Right? So what are your key rules then? Example 3, first time reval upwards, straight to the reval surplus. Example 4, first time reval downwards, straight to the P&L, the full loss. 5 and 6 get a bit more complicated. Second time revaluation, first was up, then it's down. The revaluation loss wipes out any reval surplus attached to that particular asset, not other assets. Any extra loss that might go over and above that goes straight to the P&L. For 6, it was an initial revaluation downwards, which would have hit the P&L, and then a subsequent revaluation upwards. Any reval gain now in the second revaluation, that can credit to the P&L to reverse that previous loss. Any gain above that, like we have here, that surplus goes to the OCI. So really, you can only reverse it up to the original entry. After that, then it reverts back to the normal treatment like you have in example 3 and example 4. Now, they're not easy. And that's, I think, a step up from AF1, and it's about practice, particularly the Margaret Darcy textbook. That one you'd have covered in AF1, and it's available in ebook format. That's a very good chapter in IAS 16 as well that covers all of those in a good bit of detail. The other key thing to watch for here is a little rule or provision in IAS 16 is when a company revalues an asset upwards, it will actually have larger depreciation because you're depreciating a larger amount. So essentially you're actually worse off in the P&L because your depreciation expense has gone up. So IAS 16 gives you the option. Now it's not a requirement. You have the choice if you want to or not. You can transfer some of the revaluation gain from the reval surplus to retained earnings each year. So you're transferring it from being unrealized in the reval surplus to being realized in retained earnings. And thus it will be able to be distributed as dividends. And the key amount you're allowed to transfer is the additional depreciation because you've revalued the asset. So there's a particular requirement how much you can transfer each year, right? So it's essentially saying you will not be worse off because you've revalued upwards and because you're charging extra depreciation. They allow you to transfer that extra depreciation from the reval surplus to the retained earnings if you so wish. Now, the general assumption here is the policy is not chosen unless I tell you in the question. So unless I tell you that this company has chosen to take this excess depreciation policy, you can assume it's not relevant for the question. All right. So let's look at example 7 and illustrate how this might work. So this JD Limited prepares financial statements to the year in December each year. Company's depreciation policy, full year depreciation in year of acquisition, none in year of disposal. Straight line over 50 years. And it does elect to transfer depreciation on revaluation. So we know that is relevant for this one. So let's look at the cost. Cost here, $390. 1st of December, January 2013. And then you've accumulated depreciation and your net book value at the 31st, the 12th of 13. So you only have 1 year's depreciation. So it's 390 over 50, 78. So your net book value at the end of the first year, 382,200. Because it's both in 2013. Right? And remember, because the revaluation is at the end of 13, we charge depreciation as normal for 13. We only charge depreciation from 14 onwards based on the revaluation amount. So be careful of whether valuation starts at the start of the year or the end of the year. That will dictate when depreciation gets charged and on what number. So that means your revalued amount is 416,500. And the difference there is your reval gain. Now we can just briefly go through the debits and credits just to confirm it. So you're going to clear out accumulated depreciation, 78. You're going to debit the cost account to bring it from 390 up to 416,500. And you're going to credit the reval surplus, 34,3. Right? There's nothing difficult there. First time revaluation upwards. And that's all in 2013. All of those accounts are starting. In 2014 then, it's a bit trickier. Depreciation now in 2014 is going to be 416,500, careful, divided by 49. Why 49? Because you're told the useful life assumption did not change. So if you assumed it was 50 years when you bought it, it's now 1 year less. So there's only 49 years left. It didn't say it's gone back to 50 by adding another year on. It said it hasn't changed. So if it was 50 when you bought it and you've used 1 year, it's now 49. That would have caught students out. Right? So you would have debited depreciation, credited accumulated depreciation. 85 and 85. All right. So that's important that you get an idea of where that's coming from. So what we can see here is in 2014, just because you have revalued the asset, not changed the as you revalued it, you have a larger depreciation charge. So what IAS 16 allows you is the additional depreciation, which is 85 minus 78, which in this case, 85 minus 78, 700, that is allowed to be transferred between the revaluation surplus and retained earnings, on the logic that you shouldn't be penalized for just revaluing the asset that your depreciation goes up. As you're using the asset, you can realize some of that additional depreciation. So you'll debit the reval surplus and credit retained earnings. It doesn't go through, be careful, this does not go through the P&L. It goes through the statement of change in equity as a line item. So you'll never see this in the P&L. Reduce your reval surplus, 700, and credit retained earnings. And you would do that each year that you own the asset. So every year that you own the asset, you reduce a bit more, and that's going into retained earnings. And of course, retained earnings are available for distribution to shareholders. So it's a little small one. It doesn't come up in every question, but it's important that you get an idea of exactly what we're looking for. Right? So watch for that in terms of IAS 16. Simple thing, but if we tell you in the question that they do transfer excess depreciation, we want you to do it. If we don't mention it, well then you can ignore it completely. So it depends on the outline of the question. The other key thing that's dealt with in IAS 16 is the disposal. So disposal of property, plant and equipment. And it's actually very similar to how we deal with a revaluation. On a disposal, you're going to have to recognize a profit or loss on disposal. You get rid of all the asset and you bring in the proceeds and you recognize then whether it's a profit or a loss on disposal. And that's the item that goes to the P&L. So again, this should be bread and butter to you coming from AF1. So the easiest way to look at this is, well, let's look at an example. Right? You might have used disposal accounts last year. We'll show you how a disposal account might look. It's not mandatory. You don't have to use it as long as you can do the key debits and credits. So an item of machinery was sold for cash of 30,400. So the proceeds are 30,400. The cost was 75 and the accumulated depreciation was 38. So the net book value at disposal was cost minus accumulated depreciation. So that's the way I look at it initially. So essentially I'm saying I sold an asset in the accounts worth 37 for 30,400. So if we go back, our proceeds here are less than our carrying amount. Right? Proceeds, the 34, is less than the carrying amount. So that means I've made a loss on disposal of 6,600. Because you've sold or you've swapped one asset out and you've brought cash in. So you've made a loss on disposal. So the way I always look at the debits and credits, if you look at the shorter method, is number one, remove all traces of the asset, which is the cost and accumulated depreciation. Number two, bring in the proceeds. And number three, recognize profit or loss on disposal. So there's always 3 steps in a basic disposal of property, plant and equipment. You get rid of the cost account, credit the cost, 75. You get rid of accumulated depreciation, 38. So they won't balance because we have to look at it in total. You say you got rid of the asset, you bring in debit bank, 30,400, and then you will debit the SOPL, 66, to recognize the loss on disposal. So you have the 4 key entries there. That side you have 75, on the credit side you have 75. And that's a key thing you need to watch for when you're looking at these questions. Is do I know the debits and credits? In most exam questions, I won't give you what accumulated depreciation is. I'll expect you to calculate it based on your knowledge of how to calculate depreciation. So it's a bit more work when you're dealing with it from a perspective of debits and credits like that. So you get rid of the asset, bring in the proceeds, recognize the profit or loss on disposal. Since check your calculations with your debits and credits as well. Now, that's the shorter method. You could bring all of these to a disposal account. So by example, credit cost 75, debit disposal account 75. You could debit accumulated depreciation 38, credit disposal account 38. You could debit bank 34, credit disposal 30,400, and then you would debit SOPL 66, credit disposal account 66. So you can use the disposal account if you wish. Right, it's not mandatory, but it's just in case you see it laid out in a question like that, it's essentially if you removed all those disposal accounts, you still have the 4 key entries that we have above. So disposal account is just like a temporary way of calculating the profit or loss on disposal. It's not mandatory. I won't expect you to use it. If you can give me those 4 key entries and calculate the right profit or loss on disposal, that's fine as well. So there's no requirement to use a disposal account. It's only a temporary account. It will always be cleared out at the end once you calculate the profit or loss on disposal. So let's have a look here. Just do a disposal account for argument's sake. Disposal. And we'll underline it, I suppose. So here we have cost account. You're just going to say cost 75 to match the debit you have up there. You're going to do accumulated depreciation 38. You'll do bank 30,400, and then you'll do SOPL 66. So when you tot them up, it balances both sides. And you've cleared out your disposal account. The disposal account is really only used as a temporary calculated account to figure out what the profit or loss on disposal. This is not credit the P&L, be careful. That's credit the disposal account. The corresponding entry is debit the P&L. And we know debit the SOPL is an expense. Another variation that you can get in your disposal account is what happens if, or disposal scenarios, what happens if it's a trade-in rather than actual a sale for cash. It's a very similar circumstance where you're dealing with, it's a disposal of an asset, but you're not getting cash now, you're getting a trade-in allowance, but it's a similar logic. So read through the example again, try and pause it now and make your own attempt before you walk through the solution with me here. So an asset was purchased on the 1st of January 2012 for 40,000. So we'll say the cost, 40,000. Accumulated depreciation we're given as well. Sometimes in exam questions, I'll ask you to calculate that yourself based on the number of years. But in this question, it gives you directly 26.8. So our net book value is 13.2. It was traded in against an asset with a list price of 56. And the trade-in allowance given was 15,000. And the check was issued for the net cost. Right? So essentially what we're saying here is you're trading in an asset that you have in the account at 13.2 for 15,000. That is a gain. That's a profit on disposal. It's still a disposal and you're making a profit of 1.8 because you're now not comparing to this is proceeds. It's just not in the form of cash. It's in the form of a trade-in allowance. So the debit will be slightly different. Calculations are still the same. Right? So in our case here, number 1, remove all traces of asset. Again, as we've done before, credit the cost account, 40. Debit accumulated depreciation, 26.8. Nothing like we've done before, it's the exact same as we've done before. Bring in the proceeds. Now I'm going to put proceeds in inverted commas there because it's not actually bank. You're getting an allowance. So debiting bank is not correct here. You're going to debit the cost account, 15. Because this is 15,000 towards a new asset. And we'll see that's a bit more complicated than which I've come across before. And 3, then recognize profit or loss on disposal. So it's going to be credit the SOPL 1.8. So if we look at it, we have 41.8 on the debit side, 41.8 on the credit side. So that's how you would recognize the disposal of the asset. Right, now you can do a disposal account if you wish yourself. Similar logic to here. You're going to get the same answer. You're going to credit the SOPL 1.8 as a finish. I don't mandate using a disposal account. You can if you wish, if you find it helps you. The one other entry a lot of students forget here is the net cost of the new asset, which will be debit cost account for PPE, 56,000 minus 15, and credit bank, 41,000. So the trick here is you're getting a trade in, so you have cost gone up 15, but you're getting a new asset of 56, and you're paying a check for the net. So you're putting down a trade in of 15, you have to stump up the other 41,000. So that will be debit the cost account. So you're now taking out the cost of 40 for the old asset, bringing in a cost of 56 for the new asset. And you're paying bank of only 41 because you're disposing of another asset as a trade-in. So the trade-in is not a million miles away from a normal disposal. What you have to watch for there is you're not debiting bank. You're debiting the cost of a new asset. And don't forget it's only a partial trade-in. So you're going to have to finance that either through writing a check or maybe financing it through a new loan, which will be credit loan there instead of credit bank. Just small little things, more exam level ones, where you can have a trade-in, which is part of a disposal of PPE as well. But you'll see some of those in the question pack relating to IAS 16, which is up on Loop. Right. The other thing to watch for when you're dealing with property, plant and equipment is it allows the revaluation surplus to be transferred when the asset is sold. So if you sell an asset that had previously been revalued, you can actually get rid of the whole reval surplus. So as a separate working, you'll reduce the reval surplus and you'll then credit retained earnings. Be careful, this is not made through the P&L. This is going through statement of change in equity. So you wouldn't put this in as a profit figure in the P&L. You're translating an unrealized profit into a realized profit. Revaluation surplus is unrealized, you take that out and you put it into retained earnings, which is realized and it can now be distributed to shareholders in the form of dividends if the company wants to. So just watch for that if there is an asset that was previously revalued and now it's sold. So the examiner will tell you that in the question if they're getting at that particular aspect. Disclosure-wise, you'll see these in all the main examples of financial statements that we've given you for the different classes, all the different assumptions around useful lives, around depreciation rates, the method used, and also they have to show a reconciliation between the opening and closing balances on property, plant and equipment. So usually that's a very substantial working in all of the annual reports that you will see. And we look at an example in a second of Glanbia just to see how they lay it out. But just have a look at it, it's quite an important working. As well as that, you have to show about if you're revaluing it, who revalued it, right? The qualifications involved, the date of the revaluation, and any assumptions that were made as well. So there's a lot of particular requirement disclosures, and that's all coming from IAS 16. Right, so remember, the first part of all of those international standards are the actual accounting requirements. At the end of each of those standards, there's disclosure requirements as well. So that is important that you're aware. These are all being mandated from these standards. So let's look at one example then in the real world, Glanbia note 16 of a real world example of IAS 16 disclosures. So if we take a look firstly at Glanbia, I've just taken the annual report. So you see there, I think I have note 16 by access, note 15, 474 million non-current assets, property, plant and equipment. And we go on and we see, can we find then note 16, a bit of ahead of ourselves there. So note 15 there, you see the breakdown, the year ended, the opening amount, all the additions, disposals, impairments, depreciation, and the closing amount. So it reconciles, for example, land and buildings, property, plant, equipment, each class of asset has to be given a reconciliation. And then you disclose down the bottom anything that has held under finance leases or anything held under, for example, construction as well. So there's plenty of key disclosures there, and that table is quite common that you look at in property, plant and equipment. Similarly, if we look at for example here, in the model financial statements that I've given you as well, property, plant and equipment is just a template. It doesn't have any numbers in it, but it's note 19. So if we come on there to note 19, you can see the same table. The different classes of property of different columns, they have to be shown separately, and you reconcile between opening and closing balances and showing the use of financial statements, what's driving those differences. And what I like about the model financial statements, in contrast to CRH or Glanbia, it tells you what paragraph. It's paragraph 73, subsection D and E, of why these have been disclosed. You keep coming down, it'll tell you in the next page, why are all these been disclosed? Impairment losses, closing balances. It'll tell you about the fair value, the disclosures around fair value in paragraph 95. So who the name of the valuer was, what date it was being revalued at, any assumptions. Comes down here, you're talking about if you're fair valuing it, how you fair valued it, particular standard for that. And you come down here in terms of if there's been any disposals or classified as held for sale, any impairment losses during the year, or any assets pledged as security. And what I like again is that you see the particular standards. We'll be covering IAS 36 in 2 weeks' time, so you'll see a lot of those as well. But you can see what paragraph in IAS 36 these disclosures are there for. So it is quite detailed when you get to that level of detail. I don't expect you to know the detailed paragraph numbers or anything like that, but I do expect you to have a look in the real world how, for example, IAS 16 is applied. What do the disclosures look like, and what are the types of things to expect if you're looking at a set of financial statements. In terms of comparing international standards with UK and Irish GAAP, IFRSs, both of them are broadly the same. Under FRS 102, there's not as much detail in terms of revaluation model, and FRS 2 doesn't require as many disclosures. But the broad principles in terms of how to account for them, how to capitalize them in terms of initial recognition, how to calculate depreciation, they're all quite similar. There's only a couple of small disclosure differences that are not material in terms of the AC220 module at least. So hopefully most of that was a revision for you. As I said, particularly here, my starting point would be the Darcy textbook. Chapter 25, have a look at that. It's available in ebook format. Then have a look at either of those, Connolly or Elliott and Elliott. They're probably a bit more advanced than the Darcy one. So I wouldn't start there unless you're particularly comfortable on it. And then have a look at question pack 9. I'm going to put up the solution to those quite soon, and have a look at the IAS 16 questions. There's also IAS 20 and IAS 23. We'll deal with those in week 6 after we come back from Read a Week. All right, so that's finishing off IAS 16, revision for most, but as I said, a key standard in AC220. And there's no AC220 past paper that has not examined IAS 16, property, plant and equipment, in some way, shape or form.